Okay, so we move to question 3 of the paper. Question 3 again has a computation in part A and theory, so be very keen once again. Part A says the following information relates to Pete Massa, who works in both Kenya and in the United Kingdom. The following information relates to Pete Massa, who works in both Kenya and in the United Kingdom. 1. During the year of income 2021, he earned £30,000 from employment. Pay deducted was £4,200. That is from the UK. His employment income in Kenya was 1,960,000 shillings. Pay deducted was 384,000 shillings in the year. That is in the same year, 2021. 3. The employer provided accommodation to his family, which lives in Kenya. The house is fully furnished at a cost of 340,000 shillings. 4. He also received consultancy fees of 70,000 shillings and net royalties of 95,000 shillings. Note: assume the average exchange rate during the year was £1 to 120 shillings. Required: calculate the tax payable by Pete Massa for the year of income 2021. Assume Kenya and United Kingdom have signed a double taxation agreement for 6 marks. Now, this is a question touching on what we call double taxation treaty and double taxation relief. The topic is taxation of cross-border activities. There are several topics there, subtopics. We have the subtopic of tax havens, the subtopic of most favored nations concept, transfer pricing, and all that. So this is particularly touching on double taxation treaty and double taxation relief. So we have some data about an individual who earned employment income from United Kingdom, employment income from Kenya, and other incomes. Then we are told to calculate the tax payable by Pete Massa. So for us to get tax payable, we must first of all compute double taxation relief, DTR. So this is what we do. So we are answering question 3A. The first thing is to compute double taxation relief. Double taxation relief, DTR. Now, double taxation relief is computed in about 5 steps. Step 1 is to compute the taxpayer's total income. Total income. Total income in this case means income earned from the foreign country and income earned from Kenya put together. So let's begin. 1, we are told he had employment income of £30,000 from United Kingdom. Pay deducted was £4,200. So we are saying here income from United Kingdom. And because we are going to compute it in Kenya shillings, we have to convert everything into Kenya shillings. So we are told to assume an exchange rate of £1 to 120 shillings. So we shall do 30,000 by 120. 30,000 by 120 is 3.6 million. The rule is, again, when computing DTR, we use incomes gross of payee, or employment income gross of, that is before pay is deducted. So listen to this. We are told he earned £30,000 from employment. Pay deducted was £4,200. So here we are not told whether this 30,000 is net or gross of pay. So to be safe, we have to make an assumption. So under notes and assumptions, we can say that the employment income from the United Kingdom of £30,000 is assumed to be gross of pay. That is before pay is deducted. So that would make this statement, this computation right. Alternatively, we could also assume that this £30,000 is net of pay of 4,200. So in that case, we would add 4,200 to 30,000. So in such a case, be keen and make the right assumption. 2, we have employment income from Kenya. Employment income from Kenya. This requires a small working because there are a number of items. Let's run that small working one. Employment income from Kenya. Employment income from Kenya. So one, we had the basic pay of 1,960,000. That is, and the pay deducted was 384,000. Again, back to the notes and assumptions. Remember, we said we are assuming the employment incomes from Kenya and United Kingdom are assumed to have been stated gross of pay, that is before pay is deducted. Then we are further told in note 2 that he had, note 3, sorry, the family was provided with accommodation in Kenya. The house is fully furnished at a cost of 340,000. There are two benefits in this case, two employment benefits. Number one, we have the furniture benefit. How do we tax that? Furniture benefit is, taxable furniture benefit is 1% per month of the cost of the furniture to the employer. So we are told the house was fully furnished at 340,000 shillings. So we are not told whether this family occupied this employer's house for the entire year. So in that case, we must make an assumption. So notes and assumptions. 2, you can say it is assumed that Pete Masa's family occupied the employer's house for the entire year. It is assumed that Pete Masa's family occupied the employer's house for the entire year. So in that case, we shall say, add furniture benefit, which is 1%, and because we are assuming the family occupied the house for the whole year, we shall multiply by 12, then by 340,000. So 1% by 12 by that, so it is 12% of 340,000. I'm getting 4,800. 4,800. Get the sum of that plus 1960,000. That is 2,800,000. Then we say add housing benefit. Housing benefit is 15%. So 15% of that should be 300, 120. So 320 plus that should be 2,300,920. So this becomes his total employment income. Total employment income from Kenya. That is what you need here. 2,300,920. He also had other incomes. One, he had net royalties of 95,000. Net royalties. Net royalties here means after withholding tax has been deducted. That is at 5%. So we gross it. We say royalties income. That is 100 over 95 times 95,000. That should be 100,000. Then we had consultancy fee. That is, we are told he received consultancy fee of 720. We normally receive consultancy fee net of withholding tax of 5%. So we gross that. That will be 100 over 95 times 720,000. I get 757,895. I add to 100,000 plus 2,300,920 plus 3.6 million. We get 6,758,815. So this is Mr. Pete Massa's total income for the year 2021. That is step 1. Step 2 is to compute total tax on total income. Total tax on total income. That is his tax liability arising from all his income. That is both from Kenya and from outside Kenya. So we write here, but step 2, total tax on total income. Total tax on total income. So we tax this figure. We use 2021 table. So turn to that table. 2021. So we say first 288,000. First 288,000 at 10% is 28,800. Then we have next 100,000 at 25%. Should be 25,000. Then we have excess. So excess you get as this. It is simply the difference between the total amount you are taxing, that is 6,758,815, less the amount you've taxed so far, that is 388,000. The rate is 30%. We do that, so we shall have 67,58,815 less 388,000 times 30%. I get 1,911,244.5 added to 25,000, then 28,800. I get 1,965,044.5. So this becomes gross tax liability. Gross tax, that is total tax on total income. We move to step 3. Step 3 is to compute total tax, or rather tax on Kenyan income. Step 3 is here. Tax on Kenyan income. So Kenyan income is simply, in this case, total income, that is 6,758,815 less the income from the UK, which is 3.6 million. And that gives us 6,758,815 less 3.6 million. I'm getting 3,158,815. That is what we tax. So we say first 288,000 at 10% should be 28,800. Next 100,000 at 25% should be 25,000. Then excess should be 3,158,815 minus 388,000 at 30%. We do that together. Less 388,000 times, sorry, let's do it together. 3,158,815 less 388,000. I'm getting that 22.770815 times 30%. 831,244.5. We add to 25,000 plus 28,800. I'm getting 885,044.5. So this is tax on Kenyan income. Step 4 is to compute Kenyan tax on foreign income. Kenyan tax on foreign income. The simplest way is to do total tax on total income less tax on Kenyan income. Tax on Kenyan income. So total tax on total income we got to be is here. Step 2, 1,965,044.5. Then tax on Kenyan income is 885,044.5, and we get it as I'm getting 1,080,000. 1,080,000. Step 5 is to get DTR. Step 5 is DTR. Now DTR is lesser of 1. Kenyan tax on foreign income. In our case, we gotten that to be 1,080,000. And 2 is foreign tax on foreign income. Foreign tax on foreign income. The tax paid in the UK, we are told, was 4,200 pounds. So 4,200 pounds, we convert that into shillings, we multiply by 120. So 4,200 by 120 is 504,000. 504,000. Therefore, DTR is Kenya shillings 504,000. That is the double taxation relief that the government will grant to this taxpayer for the year 2021. So with that now, we can answer the question. The question is calculate tax payable by Pete Masa. So tax payable is simply gross tax liability less the DTR and other relevant tax credits. So we do that as this. Net tax liability. So let's compute tax payable or net tax liability. So we start this as gross tax liability is equals to the one from step 2, 1,965,044.5. Then we say less 1 payee, that is the payee paid in Kenya. The payee paid in Kenya, we are told, was 384,000. 384,000. 2, we have double taxation relief, which we have determined to be 504,000. Then we have the withholding tax paid on royalties. So withholding tax on royalties, which is 5% of 100,000. The gross amount we got to be 100,000. That is 5,000. Then we have withholding tax on consultancy fee. 5% of gross consultancy fee we got to be 575, 895. 575, sorry, 757, 895. 5% of that, you work it out. 5% of 757, 895 should be 37,895. Then the last figure becomes the tax payable by this taxpayer. So we do it keenly. 1,965,044.5 less 384,000 less 504,000 less 5,000 less 37,895, and we have 1,034,149.5.
Okay.
So that gives you 1,034,149.5, 149.5, and that becomes the taxpayer's tax liability for the year 2021. And that marks the end of part A of question 3. So that reminds you to have a detailed understanding of the topic, taxation of cross-border activities. Question 3B is a theory question saying, explain 4 measures that a tax revenue authority might adopt to reduce tax gaps or revenue leakages in taxation of the digital economy. Explain 4 measures that a tax revenue authority might adopt to reduce tax gaps or revenue leakages in taxation of the digital economy. Now, this is an issue touching on emerging trends. Now, in the world today, most firms are digitalizing their operations, and so a lot of business transactions are conducted digitally. So that means the revenue authorities must also upscale their activities and be able to be at par with the investors or taxpayers in this economy. So the question is, what are these measures that the tax authority might adapt so that they reduce revenue losses or revenue leakages in taxation of the digital economy? There are many and numerous measures. So as I said, in such a theory question, first have what we call an introductory statement. So you could put it like this. The following are measures that a tax revenue authority might adopt to reduce tax gaps or revenue leakages in taxation of the digital economy. The following are measures that a tax revenue authority might adopt to reduce tax gaps or revenue leakages in taxation of the digital economy. Then explain as many as you want. One is the introduction of what we call withholding tax system on payments made for digital goods and services. Now we know with holding tax system will greatly reduce or rather minimize the levels of tax evasion, so that the government can collect, so that the government through the revenue authority can collect as much revenue as possible from this particular economy. So one measure is to introduce the withholding tax system on payments made for goods and services, or rather for operations or transactions in the digital economy. Number 2 is that the tax authorities can ensure that all participants or all traders or taxpayers operating in this economy are properly registered by the tax authority itself as well as other regulators. What will that do? That will help, one, ease the issue of tracking these taxpayers in case of any issues, and in short, it will ensure compliance in this particular economy. So then another measure is to ensure proper registration of all taxpayers. So I've talked of 2 measures. Number 1, I've talked about the introduction and ensuring a proper withholding tax system. Number 2, I've talked about proper registration, requiring that all participants in this economy are properly registered by the Revenue Authority and other regulators, so that easy tracking can be done and that there's compliance in this particular economy. A good example in Kenya, for example, is in the issue of mobile phone operators. Today, if you are buying, for example, a SIM card, you have to register it properly. And that will ensure that your mobile phone operator has all the details it needs to know about you, which it can then share with even the Kenya Revenue Authority for purposes of proper compliance. Number 3, Another measure is imposition of heavy penalties on tax evaders in the digital economy so as to discourage potential tax offenders. So the tax authority can ensure that whoever is found guilty of tax evasion in this particular economy are punished heavily so that may discourage potential tax offenders in this economy. Another measure could be the integration, or rather through the collaboration of the tax authority and other participants in the digital market. A good example today in Kenya is KRA collaborating with financial institutions like banks to ensure that there is compliance by all taxpayers. Today, for example, if you walk into a bank to open an account, you must provide your tax details or PIN certificate and all that. The reason for that is to ensure that any transaction you undertake with the bank can be monitored and accessed by the tax authority, so that you have to pay taxes on all incomes you earn from digital operations. Another measure, more than four already, the question requires this, but you can add more. Another measure could be ensuring that the tax officials are properly trained so that they are able to monitor and audit the digital market operations. A good example of such will be the tax assessors and tax auditors. The tax authority can ensure that such are properly trained so that they are able to audit operations in the digital economy that is, so that there is compliance from that particular sector. So those are some of the measures that a revenue authority might take to reduce revenue leakages in taxation of the digital economy. That is part B of the equation. Part C1. Explain the tax implications of the following. Explain the tax implications of the following. 1. Where two or more entities enter into a joint venture, agreement, or partnership. Where two or more entities enter into a joint venture, agreement, or partnership. Now, there's a very thin line between a partnership and a joint venture. A partnership is a trade association, rather an association between two or more persons carrying on a business with a view of sharing profits. A joint venture, a partnership can be for all manner of business transactions, but normally a joint venture is for a particular transaction or a particular project and rather. So the question is, we explain the possible tax implications in case of a joint venture, agreement, or a partnership. Let me start with partnership. In a partnership, number one, there must be an agreed way of sharing all the profits and losses from the partnership. So in short, in a partnership, every partner is entitled to a particular share of profits and even losses of the partnership. In a joint venture, on the other hand, so in short, I'm saying, one is that in a partnership, each partner will be taxed on their share of benefits from the partnership business. The benefits can be in the form of salaries, it could be in bonuses, it could be interest on capital, and even share of the overall profit. In a joint venture, on the other hand, each adventurer will be taxed, or rather may be taxed as a corporation or a partnership, or they may be simply allocated a gross receipt of the joint venture based upon their bid. In a short, in a joint venture, each participant bids, or rather asks for a given allocation from the proceeds, or rather from the income of the activity. So then each participant will be taxed on the income they earn from that bid based on the amount they had bidded and their expenses they incurred to accomplish their part of the bargain. 3 is that in a partnership, there must be a particular agreed profit and loss sharing formula In other words, there must be agreed profit and loss sharing ratio. For a joint venture, on the other hand, each adventurer is taxed on income arising from their bid and expenses. Another key difference is about the transfer. Sorry, I'm still on part C. Yes, so I've explained about three clear differences. Number one, I've said, in case of a partnership, each partner will be taxed on their share of benefits from the partnership business. Two, in case of a joint venture, each adventurer may be taxed as a corporation, or they may be simply allocated gross receipt of the joint venture business upon their bid. So in short, in a joint venture, there's no particular, there's no particular way to share the profits. Each bidder or each participant is allocated a given amount, which will inform their taxable income. Another difference is that in case of a partnership, there must be a particular agreed upon loss sharing formula or ratio, which will determine the partner's taxable income. For a joint venture, on the other hand, each adventurer is taxed on the income arising from their bid and expenses. The other difference is here that in case of transfer of assets by a shareholder into the joint venture, such transfer may be treated as a disposal of such assets, and this may give rise to tax liabilities in case of capital gains. On the other hand, in case of a transfer of assets by a partner into a partnership business, the same is treated as a capital contribution, which does not attract any taxes. So mark that. In case of a joint venture, any transfer of assets to the joint venture company may attract taxes in case of capital gains because it's treated as a disposal of such assets. But for a partnership, on the other hand, it is such transfer of assets will be treated as a capital contribution, which will not attract any taxes. That was C1. C2 says, explain the tax implications of the following. 1, 2, that is the second part, sorry. Where shareholders are wholly or partly paid in cash for forfeiting their shares in a cessation of business. Where shareholders are wholly or partly paid in cash for forfeiting their shares in a cessation of business. Now, in case of a cessation of a company, that is in a case of a company closing down its operations, such a company will have to pay its shareholders, of course, after paying the lenders, the creditors, and all that. So what happens? What are the possible tax implications if such shareholders are paid in cash so that they forfeit their shares? Number one is that the company itself does not recognize any gains on distribution of cash to the shareholders. Rather, it is the shareholders who should be concerned with the taxation issues. In other words, this company that is paying its shareholders so as to forfeit their shares at the cessation of business, the company does not recognize any gains on such distribution of cash to the shareholders. Rather, it is the shareholders who should be concerned with the issues of taxation. Number two is that in case of cessation of a business, any cash distributions to the shareholders equal to or less than their capital contribution, or rather less than or equal to their investment in the business, will be treated as simply compensation of capital, or will be treated as return of capital to the shareholder. In other words, they will not be taxed in case the amount they are receiving is equal to or less than their capital contributed in the company. Number three is this: where such shareholders are paid cash more than the amount their investment or their capital contribution in the company, then anything in excess of such investment will be treated as capital gains, and such will attract capital gains tax at 5%, which will be final tax. So those are the tax implications in case a company pays shareholders in cash to forfeit their shares in cessation of business. I've talked of 3 key points. 1, the company does not recognize any gains in such distribution. Number 2, any cash distributed to shareholders equal to or less than their investment in the company will merely be treated as return of capital on investment, or rather return of capital to the shareholders. Then 3, in case such cash distributions are more than the shareholders' investment in the company, then the excess amount shall be treated as capital gains, which will attract a 5% withholding tax, which will be final tax on such shareholders. That was 3C, Roman 2. I move to 3D, saying, explain 4 possible tax implications of transferring or selling a subsidiary to another subsidiary where both belong to the same parent company. Now this again is touching on tax investigations. Now, in a group of companies, we have what we call the parent company, the mother company. Under the parent company, you have subsidiaries and all that. So where a parent company decides to sell a subsidiary company, we are asked to explain the possible tax implications. So we can introduce and say, the following are the possible tax implications of selling a subsidiary by a parent company. The following are the possible tax implications of selling a subsidiary by a parent company. Number 1 is that the parent company must recognize taxable gain, which is equal to the difference between the sales proceed, that is the amount received from the sale of the subsidiary, and the costs of such subsidiary shares. So in case the amount received, the sales proceeds, is more than the cost of the subsidiary shares, then the difference will be treated as a capital gain, which will attract a 5% capital gains tax. 2 is that if the parent company does not distribute the sales proceeds to its shareholders in the form of regular dividends, then the subsidiary sales is tax-free for the shareholders of the parent company. So in short, I'm saying, where a parent company sells a subsidiary company but does not distribute the sales proceeds as dividends to the shareholders, then such a sale will be a tax-free item or transaction on the shareholders of the parent company. 3 is the opposite now, that where the parent company distributes the sales proceeds as dividends to its shareholders, such shareholders will be taxed on such dividends. In other words, where a parent company sells a subsidiary, then shares such proceeds to its shareholders as dividends, then the parent company shareholders will have to pay taxes on such dividends. And lastly, number 4 is that for tax purposes, such a sale of a subsidiary must be at arm's length, as each member of the group is considered as a separate and independent taxpayer. In other words, for all transactions for tax purposes, there must be the arm's length principle. Arm's length principle is basically about independence. In other words, where the parent company is selling a subsidiary company, that sale must be at an independent position. You don't sell as if you are dealing with a related party. You sell as at an independent position, so that where the tax authority is convinced that the sale was not at arm's length, then the transaction may be taxed where necessary at assuming with the assumption that the arm's length principle was obeyed. So if you sold at lower prices and not at arm's length, the tax authority may tax you on higher figure because you did not obey the arm's length principle. So those are the key possible tax implications in case of sale of a subsidiary by a parent company. That is question 3D, and it should be the last part of the question. So that is question 3 in total. We have also answered question 4 and question 5, and I hope you've been able to follow through, especially on the computations and the many explanations we had to give. I think that marks the end of the session today. In our next session, we shall meet to go through question 1 and 2 of the same paper before we move to another one. So during your break, take time, go through the questions you've done again, and grasp as much as possible in preparation for your exam. See you in our next session. So I